What's up guys, Trader CJ from Cross Capital. Hope you guys are doing great. Well, I'm gonna show you guys Monte Carlo simulation. So it is a random generated model to show you analytics in terms of what's the expected outcome, probabilities, and those type of things. And it's very applicable to trading. So especially when you take your win rate percentage, your average risk reward, those type of stats, if you take it into consideration and you apply it to this random generated model, it gives you, for example, an equity curve that you can have a look at and see whether it's possible to trade your strategy or not. So this can be built in Excel spreadsheet. You can easily build it, and yeah, that's very usable in terms of understanding the actual risk in terms of your equity curve, whether you can stomach your drawdown or not. So I'm going to jump into the spreadsheet now. It is this one that I've built. So it's very simple spreadsheet, so it's nothing too complicated, so you can actually build it yourself. So, and I'm going to firstly explain what's going on here, how to use it, and then afterwards I'm going to show you guys all the formulas and how to build it. So like I said, it's very simple, it's nothing complicated, but this will give you an idea of your strategy. Right, so first of all, this is your risk. Your risk is, for example, 1, and your reward is 2. So that's the risk, for example, $60, or let's make it $100 per trade, and your reward is then $200. So you're risking 100 to make 200. So I've built in your average win percentage. If the low is 0 and the high is 100, typically it's like a coin toss. When you flip a coin a number of times over a large sample size, 1,000 coin flips, is either going to be head or tails, and so it's basically, it will show you a 50%. That's going to be the outcome of your coin flip over a large number. But they might be, for example, in the first couple of coin flips, you're going to get, for example, a consecutive, for example, tails number for more than 5 out of 10. So you might get 8 out of 10. That's going to be tails. But taking a large sample size, it will show you an average of 50-50. So if I refresh my sheet, it's going to be very close to 50%. But you can see on day 1 there was a 75% win percentage. The next day 59, 43, 51, 46, 83, 20. So but the average of those couple of ones is actually 53%, 58% after 9 days. That's the average. But after 200 days or 200 sample size, it will be at this currently it's 52%. So if when I increase this to 1,000, it will probably be closer to 50% in the end. But like I said, when I refresh it, that's actually a 50%. So right, so that's taking, if you trade with a 50% coin flip type of strategy, heads or tails, and then your risk is 100 and your reward is 200. That's the equity curve of your strategy. If you maintain this for 200 days, I'm not going to change this number of trades per day just to make it an even number of trades. So 1 loss, 1 winner, and that's the outcome of your equity curve. All right, so like I said, if I refresh this, the equity curve stays quite steep upwards. So I'm going to change this down to make it 1.5 reward. Still quite decent equity curve. All right, I'm going to change it to it's reward. Sorry for that. I'm going to change it to 1:1 risk reward. That's, like I said, your outcome might be like this. Half the year you're going to be up a lot, but still ending the year maybe in a negative or square for the year. This is the positive outcome. It might be a negative one. So it's actually going to 50-50. That's exactly 50-50. Your average win percentage is 50-50. Your risk reward is 1:1. So that's your, this will be your type of equity curve. But some guys believe in their strategy. They might have good runs in between where they actually believe in their strategy and they start showing everyone how awesome their strategy might be. Like for example, this period is a nice good equity curve, but overall that's actually a bit of sideways. But yes, it might be like this scenario. You can have run multiple simulations to see what's your actual outcome. That's a 52%, 52, 51%. All right, so I want to change this to, if you increase your win, let's make this less. I want to show you guys if you just make it less, like a 34%, average of 34%, and you make this 2.2. So even a 2, let's see, just 2 is very random. So I'm a 2.5 reward. You have a nice equity curve. So you can play around with the simulation and you can see what's the outcome. So even your average win percentage is only 34%. So it's basically 3 out of 10 trades that you need to be right, with a risk reward of 1, risking 1, 2.5 reward, and you have this nice equity curve. So sometimes this doesn't feel right in terms of having this low percentage of win rate. Like I said, closer to, it's still positive upwards. Right, so I'm going to change it back to, let's make it 100, and this increase this one to 30, or like let's make it 35, a higher win percentage. But this can actually go below 1, so let's make it 0.8 or 0.6. So risking 100 just to make $60, that's also possible, but then you need to have an average win percentage of quite higher. Let's make this 0.55, still upwards. That's almost the break-even line for this strategy to work. All right, so that is how you can play around with this specific, make it like that. All right, so you can also add, like say for example, if you have 15 trades, maximum and minimum of 2 trades per day, you can also make that random during a period, because sometimes you won't get any opportunity in the market and you still have those losses. So you can also add that to your random generated model, your Monte Carlo simulation, and get an overall idea of your strategy. Right, so this one other thing I need to show you guys that I've checked, and I just want to show you guys on the in this on this sheet. So if you take your, this is the win loss ratio, this side, this is the win percentage. Okay, so and this is basically the, I'm gonna make this a bit thicker. So this is the break-even point, I would say. It's a bit, and this is 3, 1, 2, 3, 4, 5, 6, 1, 2. Okay, so this is the way 2 is basically, and 50% is over here, and that's your 50% win percentage. 100 is over there somewhere, and this is, so even if you decrease your win percentage like this way, it's going to go upwards, like to closer to this level here. You need to have a better win-loss ratio. But this is 2 risk reward. Win-loss ratio needs to be around 2. But this is, if you end up in this area, anything up here is going to have a positive outcome, showing a equity curve like this. So go and check it out. You can play around with this. I just want to see, there's a, if you look at 33%, you want to show up around here. Yeah, you can have a look at this chart as well. Hopefully it will help you guys to understand it better. Right, so jumping right into the how to build a spreadsheet. So I'm gonna take this away. Let's delete that. I'm gonna show you guys. Yeah. Okay, so you can have your days. You can add here. How to take this rand between the, I just want to show you. Okay, so this is the rand between, the formula rand between bottom. The bottom is this one here. I'll just press F4 to lock in that cell, and then that's the top. Sorry, apologies for that. And that's the top, and then that is the, like I've divided by 100, just give me that ratio or hit rate, that win percentage decimal. All right, then I'm taking this, my risk $100, multiply by this risk to get this one here. Taking those cells, you can have a look there, and the same with this one to get my $150, for example. So I'm going to delete this one for now, and then my number of trades, let's make it, just keep it on 2 now. You can keep that one fixed. Let's start with my profit. So take my trades, multiply, sorry, okay, so I just want to start with my profit. I'm going to change this to 50. So I'm going to show you guys why, what's the reason for that. 50-50. So my profit's going to be 150. So 1 one profit, one loss. So I just want to show you guys. So take this one, multiply by this one, multiply by this one to get my one winning trade. And then same with this one. I'm taking this one, multiply by this one, and then in brackets I've taken 1 minus the rest of, which is the loss, then to get my loss, one loss. Then my P&L for the day is taking my profit minus my loss, and that's the cumulative P&L for the first day. Second day would be this one plus this one to get my cumulative P&L. Right, so I'm going to change this back to 100 and make this 0, and then my average is obviously, and then this one we can make 200. That's 200. And back here, then we can do this. Make everything 200. Then you can play around with this amount you're risking. For example, if you want to make it more, you can do that 500 or even 100 number of trades. You can also do the same calculation, which is rand between the bottom and the top, and then you can do the same calculation, get more trades or less trades within a day. Right guys, that is basically the spreadsheet Monte Carlo simulation model. Hope you guys enjoyed this video. It's a bit more detail, but like I said, it's very easy to build this on your own. And if you are interested and do have some questions, you're more than welcome to put it in the comments below. Or if there's any accounts you want to open, check out these funded accounts. I've got links in the description as well, so you're more than welcome to check it out. TakeProfitTrader, TopStep, Apex, all of those guys are listed in the description below. And yeah, all the best with your backtesting and strategy evaluation or analytics, just to check it out whether it's worth it to trade it or not. Right guys, all the best, see you in the next one. Cheers.